if there is a correction in the stock market before the end of the year, and that's what we've seen previously, like throughout the last three midterm years that Bitcoin's been around, we had a correction in stocks at the beginning of 2018 and the end of 2018, at the beginning of 2022 and the end of 2022, and then also at the beginning of 2014 and the end of 2014. And so far, we had one at the beginning of 2026, and arguably maybe we'll have one again at the end of 2026. But the point is if we do get a correction in the stock market near the end of 2026, I mean, that might encourage them to start printing more.
For months, investors have been waiting for the Federal Reserve and the broader U.S. financial system to become more supportive of risk assets. But we may now be seeing the first signs that policymakers are being forced in that direction by the bond market itself. Last week, Treasury Secretary Scott Bessent doubled the maximum size of certain long-duration Treasury buyback operations from $2 billion to at least $4 billion per operation, beginning September 9th after the 30-year Treasury yield surged above 5.3%. The immediate market reaction was significant, with long-term yields moving lower and Bitcoin and other risk assets responding sharply. The significance here is not necessarily the absolute size of a $4 billion operation relative to a treasury market measured in tens of trillions of dollars. The significance is the signal. Policymakers are increasingly willing to intervene when financial conditions become uncomfortable. According to Ben Cowen, this creates a fascinating setup for Bitcoin because if stocks experience another meaningful correction later this year, policymakers may suddenly have a much stronger justification for additional intervention. The weakness creates the political and economic justification for more support, while more support can ultimately create the liquidity and inflationary backdrop that benefits scarce assets even better. If you want to understand exactly where Cowen believes Bitcoin stands, what the stock market could have to do before policymakers respond, and why the next several months could be so important for Bitcoin, Ethereum, and the broader cryptocurrency market, make sure you watch this entire video. And before we get into his analysis, take a moment to hit the like button and subscribe to the channel if you want more data-driven analysis of the forces actually moving this market.
So, historically, midterm year bear markets have been over once Bitcoin has really crossed through the 50-week moving average, right? So you can see that it did it once we got through it in 2015, and as well in 2019, and of course in 2023. So you can see that every prior cycle, Bitcoin did not get through the 50-week moving average until the pre-halving year. But with that said, it was earlier and earlier in the pre-halving year, right? So a few cycles ago, it didn't happen until October of 2015. The next cycle, it was in April. The next cycle, it was in March. Now, that's where Bitcoin is right now, right? So you can see that Bitcoin is right at that 50-week moving average. Now, there are a couple of examples where you have seen rallies like this that were rejected by the 50-week moving average. For instance, in 2018, Bitcoin blasted through the bull market support band, went up to the 50-week, got rejected, and then we came right back down. And then, of course, the same thing happened in 2015. We sort of blasted through the bull market support band, got rejected by the 50-week, and then came right back down before then picking up and starting the bull market. So that's what I'm looking at right now for the sustainability of this rally. Weekly closes, I would say like multiple weekly closes above the 50-week moving average would really make the bear case not as strong. Because all prior bear markets that got through the bull market support band, the 20-week moving average and or 21-week EMA, every single one of them that was a fake out was rejected at the 50-week, which is essentially where we are right now. I believe the 50-week moving average is in like the low 80s, somewhere in there, maybe like 80, 81K. So that, that's sort of the line in the sand, I think, for sort of figuring out if there's further downside to go, or if this is the first time that Bitcoin has bottomed out earlier in the midterm year rather than waiting until the fourth quarter.
If you had to explain to the layman watching this why a signal, not just interest rates coming down, but a signal for capping the long end of the interest rate curve would be positive for the crypto sector, how would you explain that?
Well, I mean, I think the argument is that they're just going to do whatever they need to do to try to, to try to help markets, right? But again, like those are all short-term fixes. The problem is oil has actually gone back up the last couple of months or so, and I don't think that's necessarily been reflected yet in CPI. And so what they're doing is arguably inflationary, which is, by the way, the same reason why other assets like gold are trading higher as well. I mean, it's all basically the same trade. That is that the market they'll do whatever they need to do to try to support risk assets. But again, right now, you're not really seeing stocks follow through on that at the current time. But arguably one of the reasons for that is that we are approaching the midterm year window where stocks often show weakness, right? So we've had, since Bitcoin's been around, we've had three midterm years, not including this one, 2014, 2018, and 2022. I guess 2010 as well, but we don't really have a lot of Bitcoin history back then. And every single one of those midterm years, there was a correction in stocks at the beginning of the year, and there was a correction in stocks at the end of the year. So maybe the stock market is starting to sniff out that midterm year seasonality, and perhaps that's the reason why it's not joining the party here, at least in the short term.
Historically, Bitcoin's midterm year bear markets have tended to be resolved once price decisively reclaimed the 50-week moving average. Cowen points to 2015, 2019, and 2023 as examples, while also noting that Bitcoin has historically crossed that level progressively earlier in each pre-halving cycle. That puts the current market in an unusual position, because Bitcoin is now approaching the same line in the sand far earlier than investors might expect if they are simply repeating the traditional midterm year playbook. The critical distinction, however, is that touching the 50-week moving average is not enough. Cowen is looking for multiple weekly closes above it. Previous failed rallies in 2015 and 2018 pushed through the bull market support band, reached the 50-week moving average, and were rejected before the eventual bottom was established. So the market now has a very clear test. Can Bitcoin turn this resistance into support, or will this rally ultimately prove to be another temporary recovery? Cowen places that level somewhere around the low $80,000, making the next series of weekly closes considerably more important than any single intraday move. Let's get back to the video.
One of the things that, arguably, like if you were to look at the balance sheet of the Fed, Kevin Warsh has come out many times wanting to basically reduce this, right? I mean, I think he views it more of as a liability, but, it's actually been, if you look at the total balance sheet, it's actually been trending higher since December when they ended quantitative tightening. I think one of the things to sort of think about and to how this whole thing may play out. Again, I don't have a crystal ball. This is, as you say, dubious speculation. But if there is a correction in the stock market before the end of the year, and that's what we've seen previously, like throughout the last three midterm years that Bitcoin's been around, we had a correction in stocks at the beginning of 2018 and the end of 2018, at the beginning of 2022 and the end of 2022, and then also at the beginning of 2014 and the end of 2014. And so far, we had one at the beginning of 2026, and arguably, maybe we'll have one again at the end of 2026. But the point is if we do get a correction in the stock market near the end of 2026, I mean, that might encourage them to start printing more, right? I mean, that's obviously, but again, the issue with that might lead to more issues down the road. It would be a short-term fix, but the issues down the road is that it would only likely contribute to inflationary forces, which again is the bull case for a lot of hard assets, and it's why you also see gold performing well, right alongside Bitcoin over the last week or so. So I think but in order to do that, they would arguably need a reason to, and with the stock market at all-time highs, you can't really justify that as much. So what you could have happen is that they raise rates. There's some type of scare in Q4, like there has been the last three midterm years, and then that justifies only that one rate hike, right? Just getting interest rates back to 4%, and then completely wiping out all future potential hikes because the market is sniffing out some weakness in the labor market. But I don't really think the labor market as it stands right now is the main concern for the bond market. I think it's more so in inflation that is what it cares about right now. And until the Fed raises rates, they're going to have a hard time getting the long end to come down in any durable fashion. The thing that would probably do the most to help the long end of the yield curve is the thing they keep not wanting to do, and that's raise rates. So as I've said on my channel many times, like in the time to accumulate Bitcoin is just throughout the second half of the midterm year. So like I'm not looking to short Bitcoin at all in the second half of the midterm years. I mean, I never short Bitcoin, not even in the first half, even though, I was arguably really bearish on Bitcoin. No, I think historically the right move for Bitcoin is to accumulate it throughout the second half of the midterm year and just prepare yourself ideally for a bull run, getting us out into 2027 and 2028. So that would be what I would focus on over the next few months.
This is ultimately why I think Cowen's analysis deserves attention, even if you disagree with some of his assumptions about exactly how the next few months will unfold. The most interesting part of his thesis is that there are multiple pathways from the current market environment toward a stronger Bitcoin market. The first is the straightforward bullish scenario. Bitcoin continues to hold its recent gains, reclaims the 50-week moving average, establishes that level as support, and proves that the midterm year bottom arrived earlier than it did in previous cycles. If that happens, one of the most important pieces of Cowen's bearish framework begins to disappear. A sustained series of weekly closes above the 50-week average would tell us that the market is no longer behaving like the previous midterm year downturns that ultimately required another major decline before the next bull phase began. The second pathway is more complicated, but potentially even more powerful. Bitcoin could experience another period of volatility, stocks could weaken, Treasury yields could come under renewed pressure, and policymakers could respond with additional measures designed to stabilize financial conditions. We are already seeing that policymakers are willing to intervene. The Treasury has doubled the size of its long-duration buyback operations, and the market is now watching closely for evidence that this is merely the beginning, rather than the end of the intervention. The fact that the announcement itself produced an immediate decline in long-term yields illustrates how sensitive markets have become to policy signals. At the same time, the intervention has attracted criticism because it does not address the underlying combination of enormous deficits, rising debt service costs, and persistent inflation pressures. In other words, policymakers may be able to suppress symptoms temporarily without eliminating the underlying problem. There is also a fascinating contradiction in the current market. Bitcoin is rallying alongside gold, while long-term yields remain elevated and policymakers are already attempting to influence the bond market. That combination suggests investors are beginning to think about a different kind of risk, not simply recession or economic weakness, but the possibility that governments and central banks eventually become constrained by the size of the debt burden itself. If that concern grows, Bitcoin's role as a scarce, non-sovereign asset becomes increasingly relevant. It is not necessarily a hedge against every short-term market decline, but it becomes increasingly interesting in an environment where investors are questioning how governments will ultimately deal with enormous amounts of debt. If you found this analysis useful, make sure you hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next Bitcoin and macro update. And I want to hear from you in the comments. Do you think Bitcoin has already established its midterm year bottom, or do you still expect another major correction before the next leg of the bull market begins? Thanks for watching, and I'll see you in the next video.